So Zoe asked me to talk about kind of like mortgages and finance property, and she said, oh, we'll talk about some rates. And then I thought about it, and actually it really depends, and it really depends on a lot of things, and well, that's really what I wanted to talk a little bit about today. But first of all, I know there's a whole mix of people here, but who actually owns buy-to-lets at the moment? Not most of you. So do any of you have actually mortgages on them at the moment? Okay. So I just wanted to pick up, sorry, my name's Heidi from Swift Mortgages. So I'm self-employed. I do residential mortgages. I can do equity release, and I can do buy-to-let. Buy-to-let and properties that you live in are all counted as residential. So hopefully I can help you if you needed residential mortgages as well. But I just wanted to pick up on a couple of things that they mentioned previously about properties, and I've just made some quick notes here. Properties 57% higher today than they were in, was it 2003? Yeah. And you mentioned one of the properties, I think that was in Putney, £88,000 growth on a family, sort of basically a normal 3-bedroom semi since 2012. And that is one of the reasons why it's really difficult to give you mortgage rates, because it really all depends on various amounts of things, such as loan to value ratio. So the basic, how much you're borrowing in comparison to the property price. So maybe 5 or 6 years ago, that property that you mentioned that was £88,000 cheaper, you could probably quite easily, anywhere outside of London, put a 25% deposit down on the property, and that would be fine. You could get a buy-to-let mortgage on it, because the way that it works with affordability is that your rental income needs to cover the mortgage interest. But it wouldn't be at the pay rate, i.e. the rate that you're paying. They measure the mortgage interest rate on a stress-tested rate. And I'm going to go into a little bit more detail about that in a minute. I'm sure that you really can't wait for that. So it will depend on your loan to value, the rate that you get. So the lower the loan to value, the less risk it is to the lender, so the better rate that you're likely to get. It will also depend on you as an individual, because even though you're looking at this as an investment, if you've got any bad credit or any defaults, arrears, things like that, then you're likely to need a specialised lender, which is going to give you a higher interest rate. We did talk a little bit about limited company buy-to-lets. Back in two and a half years ago, when they said, not 2.5 years ago, it was last year, when they said that they were going to increase the tax that you had to pay, there was a lot of talk about people buying properties within a limited company situation. So it wouldn't be, if you have a limited company already, it wouldn't be kind of buying it in that. You would have to set up what they call a special purpose vehicle, an SPV, which you said you do in 10 minutes or something like that. But the problem that a lot of portfolio landlords had at that point was that they have already got the properties, and then it would be transferring that into a new ownership, really. So there was obviously a sale and a purchase and sale issue there. So I personally haven't come across many people that have actually done that, transferred their existing portfolio into limited company. And limited company mortgages tend to have a slightly higher interest rate, because not all of the lenders offer limited company mortgages. So out of interest, does anyone actually have that? Have they set up a limited company? No. Oh.
Yeah, I mean, my daughter has got a limited company, and she's having difficulty getting a mortgage because her monies are in the limited company, quite simply.
Yeah.
So how do you overcome that?
So she set up the limited company for her property?
Well, for her income, yeah, because, well, she's a model, in fact, but she now wants to get a property. So she's having difficulty really finding a mortgage.
So she as her business is a limited company, rather than she's not buying the property in the limit.
She wants to buy the property in her own name.
So that would be quite straightforward then. She would just buy that as an individual. Yeah. So the limited company is her business, that's her income. So she would then just need to provide the accounts, the self-assessments, or the limited company accounts.
And you don't see that as a problem?
I don't see that as a problem particularly, unless
I'll have your card later on.
Well, that's probably or possibly where the confusion is. You can be an owner, a property owner, and be paid by your own limited company. You're effectively self-employed, or you can actually buy the property in the name of a limited company, which is where the SPV or the special purpose vehicle comes into it. So if she wanted to do that, she would be model limited, but then she would set up a separate company for the purchase of her buy-to-let, so she effectively would have two companies. But So where was I going with that? The other thing that might, sorry, did you say something else?
Sorry?
Did you say, were you going to ask
No,
me something else?
I put you off your...
Sorry.
Right.
No, so loan to value would affect the rate of interest, and all sorts of issues really. But most of all, it's how much rent that you can get. And again, you mentioned earlier about what rent you can get. I've spoken to a lady recently who has 3 buy-to-lets, and 2 of them are actually rented out to family members for ridiculously low prices. But when you have a portfolio or a number of properties, lenders tend to look at what you've got in the background and they say, well, actually, it's not really affordable because you've got rent of 400 quid coming in onto this one. Now you want to buy another one. Although you might not be borrowing with that lender, they do look at what you've got in the background and see whether or not that all of the loans that you've got are self-funding. So I'm going to talk to you a little bit about rent. So the rent that you receive, and it's always worth when you're looking at properties to ask for a realistic rental assessment, because quite often if you go to, maybe I'm talking out of turn, but if you went to an estate agent, they might slightly inflate what rent you could get because obviously they want you to buy the property. So you need to be aware that when they do the valuation for a mortgage, they're actually doing the valuation for the property, but they're also doing the valuation for the rental income as well. So if you're saying, I can get £1,000 a month for that, but the valuer goes in and says, actually, I don't think you can because it looks like we can only get 900, then you possibly might have to put more deposit down because then your rent isn't covering what you're borrowing. So it sounds very complicated, but your mortgage advisor should be able to help you with that. So I've done a couple of examples of ones that I've done recently actually. So we've got a property valuation of 250,000. They wanted a loan of 150,000. The monthly rent on that is 1,100, and I know that can be confirmed because there's actually a tenant in there already. This is a remortgage. Typically, if you're looking at a remortgage, there's no argument about the rent because there's already a tenant in there. It's usually more of an issue, or it could be more of an issue if it's just somebody that's saying I'm buying it to rent it out because there's nobody in there already. So the valuation was £250,000, and we can get them a 1.71% fixed for 2 years. So what they would pay is £213.75 per month during that 2-year fixed term. But the stress test, which I mentioned, which is what the lender will look at the loan, the £150,000 loan, the stress test is 5.5%. So on that loan of 150,000, the interest over the year is 8,250, which means that comes up to would be £688 a month. So obviously they're actually paying, what did I say, £230 a month, but the stress test is 688. Then we have to look at whether this is a basic rate taxpayer or a higher rate taxpayer, because as you mentioned earlier, if you're a higher rate taxpayer, you are going to be paying more tax than a basic rate taxpayer. So the stress test interest must be covered by the rent by 140% for a higher rate taxpayer, which means that you have to have a minimum on that £688 interest of £964 of rent. In this instance, I mentioned ages ago that the rent was 1,100, which means that is affordable. I also did a property valuation, and this was a purchase actually, a valuation of 150,000. That was a house that was in Northampton, not around here. They only wanted a loan of 112,500, which was a 75% loan to value, but their monthly rent is 700. Went through all of the figures again, and they needed to be able to cover their mortgage again by 140%, but their stress tested interest was £516. The rent at £700 a month wasn't affordable because that wasn't 140% more. So there are the kind of things that your mortgage advisor is looking at to make sure that what you're after is what is actually affordable. And it's interesting that sort of 3, 4, 5 years ago, which I mentioned earlier, that you could probably get a 25% deposit and it would be easily covered. So if you wanted to now borrow more money out of a property you bought maybe 3, 4 years ago, that wouldn't be a problem. If you're buying a similar property now, you'll probably have some portfolio landlords that I've got are looking at having to put down £100,000 on a sort of bog standard sort of 2 or 3 bedroom house in Milton Keynes. So it is having a real effect. The other issue as well is if you only bought a couple of years ago, you are possibly going to find it difficult to remortgage with a different lender, because now even the mortgage that you've got, even the loan that you've got, sometimes isn't affordable with a new lender, and then you're kind of almost tied into having a product transfer with the same lender, which means that you're not going to get as good a rate as you would if you went with a new lender. So all of those things are kind of going on in the background with regard to your mortgage. So although people come to me and they say, oh well, I can get this with Virgin, you know, whatever rate it is, they haven't done the affordability calculation. So when you look online and I can say, well, I can get a 1.5% interest rate or whatever it is, they don't look at the criteria and all of the affordability. So it's really worth, before you actually start doing that process, is looking at it and being prepared, as I think we said earlier. Just do all of your preparation in advance and make sure that you're good to go.